Silver is trading around 115 and the tape looks like it's sprinting, not walking. This isn't a normal rally, it's a pressure test for the whole system. About a year ago, silver hovered near 30, and now it's up roughly 270%. When an old metal outruns tech, crypto, and the stock market, you ask why. In the next few minutes, I'll show you the chain reaction behind this move and the signals most people never track. Keep watching, because the biggest driver is hiding in plain sight. I'm Chill Guy, and I decode the money moves behind the headlines. If you want daily breakdowns like this, hit like, subscribe, and turn on notifications right now, and drop a comment that says Silver Rocket so I know you're locked in. That one click helps this reach the people who need it. On January 26, 2026, around 9 a.m. Eastern, the New York Fed ran a Treasury bill purchase operation. In about 20 minutes, roughly $8.3 billion flowed into the financial plumbing. That sounds technical, but it's simple. The central bank swapped cash for short-term treasuries. Liquidity goes up, and risk assets tend to feel it first. Here's the part most viewers miss. Metals don't trade only on supply and demand headlines. They trade on real rates, currency confidence, and how loose the system gets. And this wasn't a one-off event you can ignore. It's part of a scheduled program that keeps repeating like a metronome. The Fed calls it reserve management purchases, which sounds harmless on purpose. Translated, steady, ongoing balance sheet expansion to keep bank reserves comfortable. The number being discussed is about $45 billion per month through 2026. Multiply that by 12 and you get roughly $540 billion in added liquidity on the calendar. That's why this matters even if you never read a Fed statement. Markets move on flows, and flows move on policies that are already published. When headlines are noisy, the quiet documents do the real damage or the real good. The people who win are the ones who read the boring stuff. Big names have been talking more about hard assets and less about set it and forget it. Think Ray Dalio, Stanley Druckenmiller, and even Jamie Dimon sounding more open to metals, not because they love shiny things, but because they understand the scoreboard. When the unit you measure wealth in gets diluted, you diversify into what can't be printed. Don't copy anyone blindly, including billionaires. Use them as a signal to check the math for yourself. Over the last 2 decades, the Fed's balance sheet expanded massively compared to the mid-2000s. More assets on that balance sheet usually means more reserves and easier conditions. A bigger balance sheet can lower stress in funding markets, but it can also inflate asset prices. That's why hard assets often respond when liquidity cycles turn. Now look at silver across that same long window. It went from single digits to triple digits. The path wasn't straight, but the direction tracks the era of bigger money. Correlation isn't destiny, and silver can whip around violently, but when real yields fall and liquidity rises, silver tends to catch a tailwind. Silver is also the hybrid metal, part monetary, part industrial. That means it can react to both currency dynamics and factory demand at the same time. And that's why a simple savings account isn't a full plan. Interest helps, but purchasing power is what matters, and purchasing power can erode quietly. Quick reality check. This is education, not personal financial advice. Anything that can rise this fast can also drop fast, so position size and risk matter. Now let's shift from macro theory to street-level reality. A longtime coin dealer told me premiums started acting strange and not in a good way. Premiums are the extra cost above spot to get real metal in your hand. When supply is smooth, premiums are small. When shelves get thin, premiums stretch. That difference matters because spot is a paper benchmark and retail is a real-world transaction. When the gap widens, the market is signaling stress. Number 1, Fed liquidity. Calendar. When cash injections and purchases are scheduled, traders can front-run them like a known weather pattern. Number 2, gold to silver ratio. This ratio snaps and stretches over cycles, and silver often moves hardest when the ratio compresses. Number 3, COMEX deliverable stocks. Registered ounces are the metal earmarked for delivery, and that bucket can shrink faster than people expect. Number 4, lease rates and physical premiums. When borrowing metal gets expensive and premiums pop, it's a clue that supply is tight where it counts. Number 5, policy shocks in the supply chain. Export rules, mint suspensions, and trade restrictions can turn plenty into scarce overnight. Let's unpack the gold to silver ratio in plain English. Take the gold price and divide it by silver, and you get how many ounces of silver by 1 ounce of gold. Historically, that ratio often lives around the 50-60 neighborhood, but it swings wildly in panic and euphoria. And when it falls fast, silver is usually the one doing the sprinting. In the 2010-2011 run, the ratio compressed sharply, and silver surged from the teens to near 50. In 2020, the ratio spiked during the crash, then silver rebounded violently as it normalized. Today, if gold holds near the 5,000-6,000 zone and the ratio revisits 30, silver math lands around 170-200. If the ratio pushes toward 20, you're staring at 250, 300 on paper. None of that is a promise, it's just arithmetic. The point is, the ratio gives you a map for how big moves can happen when extremes unwind. Now, about comics. There's eligible metal and there's registered metal. Eligible can sit in the vault, but registered is what's tagged for delivery. The claim floating around is that registered silver fell from roughly 86 million ounces mid-2025 to around 28 million recently. Whether the exact number is 28 or 30, the direction is what matters. At the same time, paper exposure can be many multiples of deliverable stocks. Futures are designed for hedging and netting, but stress shows up when too many people want the same exit. To be fair, most contracts never demand delivery. The system usually works. But when registered stocks get thin, confidence becomes the real commodity. Watch spreads, watch delivery notices, and watch how often cash settlement gets discussed. Those are the smoke signals before a repricing. Another clue is when nearby contracts get bid up versus later months. That's called tightness in the front end, and it often appears when physical demand pulls forward. Now let's talk lease rates, because this is where the story gets spicy but still measurable. Lease rates are the cost to borrow physical silver for a period of time. In calm markets, that cost is tiny because metal is easy to source. When the rate jumps, it's the market whispering that metal is harder to borrow than it should be. Block 2. People claim lease rates near 8%, which is unusually high in modern markets. If that's accurate, it's a sign that urgent users are paying up for access. Tightness can show up in different places at once, like regional premiums. If Shanghai trades above Western benchmarks, arbitrage becomes harder and the gap can persist. This is where paper silver versus real silver becomes a real conversation. ETFs and futures track price, but physical buyers care about availability, shipping, and fabrication. And when stress rises, leverage becomes a double-edged sword. Derivatives amplify gains, but they also force liquidations when volatility spikes. Now, zoom out to the supply chain story that people underestimate. In early January 2026, reports suggested China tightened export licensing for silver through a smaller list of approved exporters. Even partial restrictions can matter because China is a major hub for refining and manufacturing. If the gate narrows, the downstream world feels it in delays and premiums. Strategic material language is a big deal because it reframes the metal from commodity to security interest. When governments do that, markets can reprice faster than models expect. Tech leaders have also warned that silver is essential for industrial processes, from electronics to energy systems. When people who build hardware start talking supply risk, that's worth noting. Then there's the coin side. A mint suspension isn't just a retail story. It's a signal that volatility is making pricing and sourcing difficult for official suppliers. The same pattern appears when national mints sell out of bullion products. When back-in-stock emails replace inventory, demand is colliding with a bottleneck. Scarcity doesn't always mean no silver exists. It means the right form in the right place at the right time is suddenly expensive. Now, the demand story, silver is the best electrical conductor of all metals. It's also highly reflective and naturally antimicrobial, which makes it useful in medicine and coatings. Solar is the headline driver because photovoltaic cells need silver paste for efficient conduction. Estimates put solar demand in the hundreds of millions of ounces per year, and growth targets keep rising. Electric vehicles add another layer because EVs carry more electronics, sensors, and power connections. More electrification means more contacts, more solder, and more silver usage across systems. Data centers and AI hardware are also metal hungry, even if the silver per unit looks small. At scale, small amounts per device turn into big numbers for the supply chain. Can engineers thrift or substitute silver? Sometimes, yes, but substitution often reduces efficiency, increases heat, or raises failure risk, so there's a limit. Here's the supply catch. Most silver is mined as a byproduct of copper, lead, and zinc. That means silver output depends on other metals' economics, not just silver's price. Even when price rises, new mines don't appear overnight. Exploration, permitting, financing, and building can take 8 to 12 years in the real world. Recycling helps, but it's not an instant refill. A lot of silver is used in tiny amounts that are difficult and costly to recover. That's why multi-year deficits matter more than a single bad quarter. When demand exceeds supply for years, inventories become the bridge, and that bridge gets thinner. The buffer is what prevents price shocks. When the buffer drains, small disruptions can create big moves because there's less slack in the system. Now add the timing element. A scheduled purchase program through April 2026 creates a visible liquidity runway. Markets love runways because traders can price them in. When liquidity is predictable, positioning becomes more aggressive. That can push trends into parabolic behavior, especially in smaller markets like silver. After that, policy uncertainty increases because leadership changes and political pressure can reshape the message. A new chair can shift tone, tools, and risk appetite, even if slowly. And that's where you respect the downside scenarios. A stronger dollar, rising real yields, or a deep recession can hit silver hard, because industrial demand can cool. Also, exchanges can change margin rules when volatility surges. That can force selling regardless of fundamentals. And it's happened in past metal spikes. So if you're watching this, don't just trust a narrator, including me. Pull up the New York Fed operation calendar, COMEX vault reports, and reputable industry surveys. Check the difference between registered and eligible stocks, and track how those numbers move week to week. Data is the antidote to hype. Wall Street targets often lag price action because banks revise slowly and hate looking early. When price outruns forecasts, the market is telling you the regime changed. More aggressive analysts float ranges like 150 base case, 200 in a tighter squeeze, and 300 if structure breaks. Treat those as scenarios, not certainties. If you want a simple dashboard, track 5 things: gold price, the gold-silver ratio, deliverable stocks, lease rates, and physical premiums. When multiple dials turn together, odds shift. Also watch ETF flows, because big inflows can soak up supply quickly. Then watch whether those flows reverse, because reversals can punch the price in the face. People compare this to 1980, and there are similarities in speed and emotion, but the drivers today include persistent industrial demand, not just speculative mania. Some inflation adjustments suggest the old peak would translate to a much higher number in today's dollars. That doesn't mean we must hit it, but it shows how far extremes can reach. Back then, policy slammed the brakes with extreme rates, and the rally cooled. Today, with much larger debt loads, the range of policy choices is tighter than it used to be. That doesn't make silver a guaranteed win. It makes the macro backdrop unusual, and unusual backdrops produce unusual price behavior. If silver swings 10% in a day, can you stay calm and stick to a plan? If not, your strategy needs adjusting before your emotions adjust it for you. The game here is preparation, not prediction. You don't need certainty. You need a framework that keeps you from chasing peaks and panicking at dips. Right now, you've got a rare combo: liquidity signals, supply chain stress, and growing industrial pull. When those stack, markets can move faster than your comfort zone. So here's your move. Verify the sources, watch the indicators, and decide what exposure fits your risk tolerance. The smartest position is the one you can hold through volatility. If this breakdown helped you see the structure behind the price, keep this channel in your feed. I post daily updates on the money mechanics most outlets skip. Tap like, subscribe, and turn on notifications so you don't miss the next shift. And share this with one person who's only looking at headlines and missing the data. Drop your take in the comments with Silver Rocket and tell me which indicator you're watching closest. I read the comments, and I use them to shape the next breakdown. The Fed sets the rhythm, and silver reacts to the beat. Stay sharp, stay curious, and I'll see you in the next one.